What if the biggest danger to your money is the very system that promises to protect it? Every generation is told the same lie. This bank is safe. This institution is stable. This one can't fail. But from the gold bankers of Renaissance Florence, to Lehman Brothers in 2008, to Silicon Valley Bank in 2023, one truth repeats: institutions don't save you. They save themselves. This is the hidden pattern behind 700 years of financial collapse. A story of trust, inflated risk, ignored, and bailouts. Engineered not to rescue society, but to preserve the system that keeps the elites in power. Today, we're retaking a deep dive into the myth of too big to fail, how it started, why it keeps happening, and why nothing has changed. Long before Wall Street, before central banks, before modern capitalism, there was Florence, the financial heartbeat of medieval Europe. 3 families ruled its banking empire: the Bardi, the Peruzzi, and the Attioli. They were rich, powerful, global, and considered too big to fail. Their clients, kings, popes, crusaders, everyone who mattered, and just like modern banks, they made one fatal mistake. They loaned too much to people who could never pay back. In the 1340s, King Edward III of England demanded massive loans to finance his wars. The Florentine banks agreed, because kings don't default, right? Wrong. Edward refused to pay. The Peruzzi collapsed first. Then the Bardi, then the entire Florentine banking system. Merchants lost fortunes. Trade collapsed. Families were ruined for generations. And the bankers, most escaped the worst consequences. They protected their own wealth through political connections and asset transfers. The world learned its first great financial lesson. When banks gamble and lose, ordinary people pay the price. Fast forward 670 years, America menos 2008 Lehman Brothers, one of the oldest and most respected firms on Wall Street, was drowning in toxic mortgage securities. But years of success had made it untouchable. Its CEO, Dick Fuld, genuinely believed the government would never allow it to fail. After all, the system depended on Lehman's survival. But here's the contradiction. The entire financial architecture was built on risk, yet pretended risk didn't exist. When the housing bubble burst, Lehman had 2 choices: come clean, or cover the truth. They chose the second. Accounting tricks, over-leveraged bets, a balance sheet more illusion than reality. Then, September 15, 2008, Lehman collapsed. Markets froze. Trillions evaporated. The world economy shook like a fault line. And in the middle of the panic, a stunning reality emerged. The US government poured hundreds of billions into bailouts, but not for homeowners, not for workers, not for retirees. The bailouts went to AIG, Citigroup, Bank of America, and dozens more. Why? Because the collapse of these other big banks threatened the system itself. Lehman wasn't saved, but Wall Street was. Millions lost their jobs and homes. Bank executives kept bonuses. Once again, institutions didn't save society, they saved themselves. March 2023, Silicon Valley Bank, the darling of the tech world, collapsed in just 36 hours. How? The bank made an old mistake with a new twist. It invested billions in long-term bonds. Right before interest rates exploded, those bonds lost value. Tech funding dried up. And suddenly, depositors wanted their money back all at once. A digital bank run, faster than anything in history. Within hours, $42 billion withdrawn. The share price was destroyed. Regulators were stepping in. And when the dust settled, depositors were protected. But not because of fairness. because the collapse threatened the entire startup ecosystem. Venture capitalists panicked. Political pressure intensified. Fear spread to other regional banks. The government stepped in, not to save SVB, but to prevent contagion. Once again, the system saved itself. Florence, Lehman, SVB. Different centuries, different technology. Same cycle. First, excessive confidence. Second, high-risk bets. Third, a trigger event. Fourth, panic. Fifth, collapse. And sixth, a selective rescue, only for the institutions the system needs. The public is told that bailouts protect society. But history proves the opposite. They protect the system from society's anger. The lie of too big to fail is not about safety, it's about power. 7 centuries of financial disasters show one undeniable truth. Institutions don't collapse because they re-weak. They collapse because they believe they're invincible. And when they fall on us. Understanding this pattern isn't paranoia, it's survival. Because the next crisis won't come from a place you expect, but from a place the system says is too big to fail. Thanks for watching.